Change at the long end of the curve though, Tom, so let's have a look at that and push through that 235, that big downside surprise on a payrolls report against an estimate of 733. Yields higher on 30s now by about 3 basis points, on 10s by 2. However way you chop this up right now, there is a view on the September the 22nd meeting that number will just anchor the hawks a little bit and stop them flying away and causing too much trouble for Chairman Powell. Let's bring in Jeff Rosenberg on that, of BlackRock's portfolio manager. Jeff, I want to start straight there, sir, with a downside surprise and your first interpretation, your first read.
Yeah, the first read is definitely this has some Delta variant on it. The mix shift here is retail's lower. Leisure and hospitality, which had been contributing, 400, 500,000, doesn't show up at all. The wage increase that you guys were talking about, that really looks like a mix shift here. And the disappointment is in those two sectors, and particularly leisure and hospitality, which speaks to, potentially this Delta variant impact. Now, because that's the fingerprints, that's a temporary impact. And John, as you just highlighted, the initial bond market reaction was lower yields, but now you're starting to kind of push higher in the back end. To me, that says the market's looking through this and seeing, hey, this is temporary. We talk about transitory inflation. We're going to talk about transitory Delta variant impact here, at least with regards to the market reaction. And a little bit of disappointment as well in terms of the labor force participation rate not budging. Again, I think that's more of a temporary factor related to the Delta variant. So I think, the market was already, pushing back in terms of expectations of when the tapering announcement would happen. This solidifies that in terms of the folks who were expecting something sooner, or the hawkish viewpoint. We'll get another month. Everyone will look for that, look for the Delta variant, hopefully, to come out of the September and even the October reports as we wait into later this year for the tapering announcement.
Governor Brayner's been on the money here for many people. Wait for the September data. Wait to see if the supply side of this economy will heal. Do you think they have the luxury of time on their side to wait for that?
They do, in the sense that, they're really going to be focused on the longer term implications. And, they have talked over and over about the necessity, particularly Powell's speech last week, the need not to react and overreact to short-term developments. And so, from that vantage point, they don't need to rush into it. And the most important thing not to lose sight of here is the emphasis that tapering is not tightening. And once we get past this tapering announcement and they go on kind of an autopilot of each monthly reduction, then we're going to shift this conversation, and it's going to be about, well, what does this do to the path of future tightening? But that path of future tightening doesn't begin until maybe late in 2022. So they've got a lot of time here before we get to that.
How important is the revision upward for the prior month? The idea that it was revised from 943,000 to more than 1 million. The idea that there was momentum and that perhaps this blip really is just a pause due to the Delta variant.
It's a good point, Lisa, and that's another part of this report. It reinforces how strong the labor market was going into this Delta variant impact, and I think that may be what the market is looking through. That this is a one-off slowdown and not the beginning of a new trend, and that the strength in the labor markets will reemerge as the reopening recovers.
Equity futures just fading a little bit here, Tom. Unchanged on the S&P 500, basically unchanged to negative on the Nasdaq now. I'll be catching up with Rick Reeder, Jeff's colleague, at the top of the hour, alongside Anastasia Amoroso and Mike Collins. We'll do that on the open, Tom, in about 20 minutes' time.
Sounds good. Lots to talk about there as well. I just did the 3-month moving average of where we are with the double revisions, and I think away from the gloom of the moment, folks, this is a pleasant survive. Jeff Rosenberg, 2250, jobs over 90 days. And that comes out to 750,000 exactly per month. I'm sorry, Jeff Rosenberg, that's not a bad number.
Not bad at all. And you're reinforcing the broader point, which is if you look through the noise, this is a very strong labor market, good recovery. Is there more room to go? Sure. And that's what some of the points many of the more dovish members have been highlighting. And that's, I think, the broader takeaway is that the reopening is happening, the recovery in the economy. The thing that this isn't talking about, and that the Fed is also going to be concerned about, and I think our focus will shift towards, is the impact of fiscal policy. We're going to have a fiscal tightening, even with a $3.5 trillion stimulus plan. That is not the same kind of stimulus as the stimulus that is rolling off. That's long-term stimulus over a 10-year period. And so the Fed's going to be concerned about the impact on economic growth of that fiscal tightening.
Are you managing then 12 months forward, 24 months forward to a 3% American economy or something? We're getting back to where potential GDP is. Is that your overlay here as you manage bond money?
That is, Tom, and it's in most of the longer run forecasts. We've had an incredibly impactful impact on short-term growth from the combination of reopening and historic amounts of fiscal stimulus. That's going to roll off, and so what is really the underlying debate or the overriding debate is, what's the underlying capacity of the economy and the strength of the economy and its ability to deliver. And most of the consensus views have you going back to that level. And the concerns on the downside is that you'll press even lower. And that's the argument against moving too quickly and overreacting to what might be transitory impacts on inflation. Now, of course, the other side of the argument is that we've done some serious structural damage to inflation expectations, and supply chain. The Fed has admitted, they've underestimated the degree and length of how long the restart economics would impact on the supply side. And so all that, that's the growth side. But it's also the inflation side.
Some interpretation here is markets reverse. NASDAQ 100 with a spike up earlier comes right back around to a modestly negative statistic. The VIX out to a 16.53. Lisa, the 10-year yield, higher now, 1.31%.
Yeah, it seems like people are looking past the huge headline message. To really reiterate what Jeff was saying, they're looking more at the upward revisions. They're looking more at the momentum heading into what was a Delta-packed month that really saw zero net jobs in the travel, leisure, and hospitality sectors, which is really shocking given where we are in the reopening. But Jeff, this really goes to the question, is the Fed getting this right? And does this data confirm that basically there is a lot of slack in the market? Or are we starting to get some concern with respect to the wage data, albeit you have to parse through it?
Honestly, it's too early to know. There's a lot of critique on both sides of the debate as to whether the Fed is making mistakes or not. One obvious concern is there is a tremendous amount of inflation, but it's not in goods and services prices. It's in assets. And you see it everywhere. And it's the asset inflation and the financial stability concerns. It's in the minutes. There are folks who are concerned about it. If that ultimately shows up in a negative way, then, the argument will be, the Fed missed it. But, given what we know today, it's hard to argue that is the case right now. And so the Fed's focused on what's right in front of them, which is they don't feel the need to, move preemptively. Right. And that's the change in flexible average inflation targeting. So they're going to be reactive. And that's the kind of Fed response function that we now live with.
Jeffrey Rosenberg, thank you so much. With Blackrock,